what does the FACTS stand for? Find the cheapest thing humanly possible. A, access, i.e. liquidity to your money. Find the most liquid, tradable, easily accessible thing possible. C, complexity. Minimize it. T, taxes. Uncle Sam will literally destroy you. And an S, it stands for search.
Love listening to Wes. The intelligence to pretentiousness ratio is the highest in the business. Now, that's just one of many glowing reviews, or technically YouTube comments, about my guest today, Dr. Wes Gray, who runs both Alpha Architect and ETF Architect. And after watching some of those YouTube interviews myself, I kind of feel like I'm getting a man crush too. So we're going to talk to Wes about Wes's business, Wes's background, his investment approach, and some takeaways and lessons that can help you with your own investing as well. So, Wes Gray, welcome.
Honored to be here, James. Appreciate you having me.
Honored to have you, Wes. Can you give us and those watching a quick intro about what you do between ETF Architect and Alpha Architect?
Yeah, you got it. So we've been around for 15 years now, and we have kind of two core businesses. We have Alpha Architect, where we try to architect alpha. Sometimes we're good, sometimes we're bad, but we're doing our own intellectual property, building our own investment strategies, and delivering them to the public. And then ETF Architect, kind of like what it sounds like, we are helping people architect ETFs. So that is an infrastructure company where if anybody wants to launch an ETF and they want to do it easily, cheaply, and transparently, they can show up and we'll basically do all the back office and infrastructure work for them. So kind of an asset manager and then like an infrastructure company.
Gotcha. And you publish pretty prolifically in your blog on, or your team does on Alpha Architect, all kinds of ideas, pros and cons. You're not just plugging one thing, which I like. I mean, you're truthfully examining everything. So part of that is because you were an academic, and I want to get to that in a minute. But can you describe your childhood and how you got into investing?
Yeah. So to step back real quick, why do we always talk trash sometimes about our own strategies? Is the mission of Alpha Architect is to empower investors through education, not sell them all of Wes's BS. And so, we want people to try to seek intellectual truth like we try to seek. And so that's why the blog, obviously everyone's got bias, but we try our best to, hey, let it roll, baby. This is an ideas farm. Let's try to get the best ideas. So that's the quick background that. I mean, as far as my background, like the real nickel tour, because this could be way too long, is I grew up in mountains of Colorado in a thing called Adamsville Ranch, which it's near Eagle, if you're familiar with where Eagle is, like the ski resorts and everything. But it's basically just a huge cattle ranch. We didn't have a lot of money, unfortunately, and I hated doing manual labor. And so at some point I was like, this sucks digging ditches. Like, how do you not do that? And then my dad's just like, well, I think you got to go get smart and go to college and get degrees and all that to avoid doing this. And so, my whole life was just, how do I not do manual labor and do something better? And I just, through time, I kind of stumbled into finance and, did the whole PhD thing, the whole ball of wax.
Amazing. Eagle is on I-70. I'm looking just a bit west of Vail, a little bit north of Aspen. So yeah, I think I have been. I've driven. I go every year to Colorado to Uray. So I think I've driven through Eagle actually.
Yeah. And Adamsville Ranch doesn't exist anymore. I think it's called Frost Creek. But if people are familiar with Brush Creek Road, like if it's South Eagle there, in the old days it was literally nothing. It was Adamsville Ranch, and now it's like golf courses and it's almost like a town. But when I was there, Eagle had like 2,000 people. Now it's probably got 20.
So in music, vocalists get praised if they have a big range. They can go very low, very high. I would say you have that range in terms of just your humanness. You speak like a regular person, but you did your PhD at one of the top schools in the world for finance, studying under a couple of Nobel laureates. What made you choose Chicago, and what made you temporarily unchoose Chicago and then come back after serving your country? I know the story as well, but I'd just like to hear it from your mouth, Wes.
Well, so the simple answer is, when you're young and dumb, you just listen to what people tell you. So I used to be the data monkey slash computer programmer research guy for the Wharton Finance Department. And at the time, it's probably still the case today, they're all Chicago PhDs.
Yeah.
And when I was at, you always ask like your professors, like, hey, what should I do when I grow up? And of course, if you ask a finance professor, what you should do when you grow up, they're like, you should be a finance professor. And I was like, great, this sounds like a great life. And I was like, well, how does that work? What do you got to do? They're like, well, you got to go get your PhD. And, we all recommend Chicago. We'll write you letters. So for me, it was just, that's why. Like they recommended it. They all went there. They said it's the best. And they said, hey, we're going to help you get in. I was like, awesome, let's try it. And so I kind of like all my mentors just pushed me that direction because that's where they went to school. And I liked what they were doing. So I figured I'd go for it.
Gotcha. And your dissertation, if I recall from the last, one of the last podcasts I watched was it Value Investing Club or some kind of
Yeah.
the act of coming together and sharing ideas, which is atypical in terms of kind of traditional Austrian economic theory, right? Everyone for himself.
Yeah.
And if I got a secret idea, I want to keep it secret. Can you
Yes.
just give a little blurb about that?
Yeah. So my dissertation topic had two pieces. There's like a theory piece and an empirical piece, like the data piece, right? And so the theory piece was just, as to your point, like usually, why, if I have a good idea and I'm in competition with you, why in the heck would I ever tell you my good idea? Like I want to be this like greedy capitalist pig and just scrape as much profits out of as possible. And the problem, that's like a logic, but the problem is it's illogical because there's actually a lot of times like collaboration actually can lead to 1+1=3 events. So, kind of the whole theory part of what I was writing about is like, hey, that's traditional Chicago school, like, pure capitalism, Milton Friedman stuff, which is awesome. But, it's more complicated than that. Like there's actually value to collaboration, sharing, what have you. And so that was kind of like out of the theory. And then you create all these predictions about, what may or may not happen. And then it just so happened, there was also an organization called Value Investors Club, which started, I don't even remember now, 20, 25 years ago by Joel Greenblatt and some really famous value investors. And the whole intent of the message board is because back then they didn't have what they had now. It was like Yahoo Finance and Raging Bull, where, it's like one person smart and there's like 900 people that are idiots. That's not like an effective collaboration.
That's probably an accurate ratio too.
Yeah. Maybe it's still like that on like Reddit or something nowadays. I'm not really involved anymore. But in the old days, it was terrible. And so their idea is like, hey, let's create an exclusive message board with sophisticated, vetted hedge fund managers and people that are professionals. And if we syndicate this group, keep it clean, make them all vetted, there's going to be value to sharing each other's ideas. And so this was like the perfect laboratory experiment to then do all the data analysis and what have you to kind of test out all these crazy theories we had. So yeah.
And I want to get to the stocks in a minute, but you're just so interesting, Wes. I got to ask, Chicago is a conventional, traditional hardline school, very, very good at that. You are ahead of your time in the sense that now we've got GameStop, we've got people literally coming together on the internet to kind of crowdsource strategies, which on one level, like it's kind of dumb. On the other level, they're pretty sophisticated in terms of how they chose their target. Do you think those people, anybody who resisted that or wasn't certain of you at the time, looks at what you did now as being prescient?
Well, so to be honest, to give credit to Chicago, when I was there, they hired this no-name dude called Dick Thaler, who's now a Nobel Prize winner in behavioral finance. Yeah. But back then, he was kind of like this weirdo behavioral science guy. They also had another guy, Nick Barberas, they hired. And that was actually, I don't know the exact details, but what the word is like Fama is like, hey, because he's a pretty reasonable guy. He's like, we're all Chicago Milton Friedman clones here. Let's mix this up a little bit. And so they literally went the opposite and hired the people that talk trash about all that. So when I was like kind of lucky in the sense that when I was there, this merging of like old school Chicago, economic, rational, everything world, and they actually brought in all these like, well, you ever dealt with real people? they're kind of crazy. They do weird stuff, you know? And so I don't want to attribute this to me. It was just that environment at the time, I think, was open to this idea that, hey, in my life, I understand these theories, but in my own personal like trading, because I used to be a big time stock picker, I was on all the message boards all the time. Like, I personally love sharing great ideas with other people that are also smart because it was always useful to me. It was useful for me. It's probably useful for a lot of other people. And so there's no theory or academics that would kind of like talk about that, even though I was in reality doing that. And so it was like kind of obvious, right? Like, if people are actually doing something, instead of theorizing about how they're acting, why don't we just theorize about what people actually seem to be doing? Because that's probably more close to ground truth, right? And so, it worked out. And then obviously now everybody does behavioral finance and considers, non-rational economic reasons for doing stuff. But, that was not just me. I would say that's led by like Thaler, Barbers, and all those, big time professors. And, I was just one of the PhDs that, was drug along the way to be part of the crowd, I'd say.
Also you. Now, for most people, Wes, even
Yeah.
just getting into the PhD program at Chicago, it's like winning the lottery. And they
Yeah.
would change their whole lives to focus everything on that, no distractions whatsoever. I'm sure you had to do that to some degree, but you did
Yeah.
something very unusual. You pushed pause for 4 years to go into the U.S. Marine Corps, serve your country, and thank you for your service, Wes. And then you
Yeah.
came
Appreciate
back.
it. Yeah.
Now, that's atypical. Can you walk
Yeah.
us through the psychology of that?
Yeah, I mean, I've just always been a little bit different. And when I was a kid, like I grew up in like nature. I was like literally like a cowboy. We'd go on like cattle drives out in the middle of the woods and live out there for a week. Like I was not like the standard like suburban kid hanging out at like Arby's or something. And so I was just always into adventure, and I was just like freedom. I'm like kind of like a cheesy American in a sense, like all like the stereotypical like love America, love freedom, love the Constitution. Like, I am all in on that trade all day, every day. And so, I just felt like if you're going to be a good citizen, you should probably do your time in some form.
Mhm.
And for me, I just felt like, hey, like, I'm going to get rich. Like, I already solved this problem now. Like I mentioned, I kind of saw the light, like, hey, this is obviously a path to not being broke. And I can go make money for the rest of my life. But, when you're young, you kind of got to like, shit or get off the pot in some sense. And so for me, it's just, I liked doing what I was doing, obviously, but I just had to take a pause tactically and just do my time. And so that's what I did. I just, I did the 2 years. You get to what you call ABD, like all but dissertation.
Yeah, yep.
And then, I talked to the PhD lady and all my advisors, and they're like, you're a wacko, but go for it. And so left for 4 years and then came back. And now I was like, all right, I did my time in the service, great adventure, but now I got wife, kids, and obligations, back into the grind like everybody else is basically the summary.
From the tone in your voice, it sounds like you'd do it again if you had that choice.
Oh yeah, yeah. It was the greatest experience ever.
Wow.
I would have paid to do it, even though
Wow.
it sucked. It's just doing the service is. I mean, it's dangerous because you could die,
Yeah.
which would not be good. But I mean, there's nothing can replicate the opportunity and the privilege of serving. I mean, at least I loved it, man. I thought it was a great opportunity.
We need like 100 million more Wes's, and we'll have like the most awesome country in the universe. That's a great attitude,
Yeah,
Wes.
appreciate it.
So,
Yeah,
well, let me segue to investing.
yeah,
Kind of a smaller topic compared to that, but thanks for explaining that. Investing style wise, I part of me wants to put you in a box so badly, but then I hear you talk about value investing, managed futures, momentum, and trend
yeah.
following. You're a member of multiple tribes that don't usually interact. How would you describe your investing style?
I would call it adaptive. Like anything. If you read enough about like human psychology, like obviously people are so biased. They seek, ego is such a powerful issue, and you want to feed that ego. But ego is a lot of times the downside of good decision making.
Yeah.
Like, in theory, you're supposed to like contemplate all the available, like be like a scientist, contemplate all the available evidence, And yes, it's fine to have strongly held beliefs, but if you get additional information and additional info, you should be able to update your beliefs, right? So that's my whole journey. And like every human being, like, I start off as like a Warren Buffett, Ben Graham, Bible thumping value investor. And, I was never leaving that tribe. But then eventually I hang out in Chicago with all these quants. I like read all this research. I'm like, geez, like there's other things out there that might be interesting. And that's been my whole life. And then I got into trend following, another religion I thought was like total like devil worshiping. And now I think it's great. And like, so I can be convinced of anything if there's enough robust evidence from a lot of different sources, and in the end, I can rationalize my brain around, like, you know what, that makes sense actually. And I'm continually evolving, adapting to new ideas that are evidence based, and I feel like grounded in financial economics. Why not?
That is a level of humility that I think maybe 1 or 2% of people in capital markets have, and it's a really amazing, Wes. Sometimes I say, you show me a confident economist, and I'll show you an idiot, right? I mean, it's a social science we're in, and so the idea of being absolutely certain and this is how I am, it feels good. It tickles our primal caveman emotions, but it doesn't map to the social science that we're participating in. So I think you're doing it right. Is my short answer for whatever my 2 cents are worth.
Yeah, no, I appreciate it. And the other thing, though, is I got lucky, right? Because I used to be a bullheaded, idiotic, egomaniac stock picker. And I got lucky in the sense I got my face ripped off in '08. And, humble pie is a great way to reset and step back and be like, kind of like joining the Marines. Like, you think you're a stud, and then you hang out with everyone who's a stud. You're like, oh, I actually need to keep grinding because I am not at the top of this food chain. And so sometimes humble pie is a great way to, like, get you back to basics and fundamentals again. But some people, they don't have the fortunate luck of getting their punched in the face, and that just naturally is going to lead to ego and overconfidence and all these problems. That's just human condition.
So before I get to ETFs, let me ask you a more primal question. I'm just kind of streaming on this, but it's about diversification, about picking stocks, because I'm trying to come down from that egomaniac phase myself. And there are two schools. One is, Charlie Munger has said that diversification is insurance against stupidity or incompetence, something like that. Warren Buffett says, make every stock choice as if you have a punch card and you got 20 stocks. And Charlie himself had 4 stocks, right? And in his own separate little thing. And also, who was it? Jack Bogle said, don't try to find the needle in the haystack, just buy the haystack. So that's the other side. Hank Bessenbinder, ASU professor, 3.4% of stocks from 1926 to 2022 drove like 90 something percent of 96 or 94% of returns. Even time wise, 1.2% of trading days. If you'd missed the best 1.2% of the S&P trading days the past 20 years, your returns would be 93% lower. So, we've got one camp saying this, and we've got another camp saying it is damn near impossible to pick individual stocks. It's a small number of stocks do all the lifting, and a small number of time periods also do all the lifting. Ergo, it's better just to like buy a big bucket and wait. What do you say to someone coming into the investing world, reading some of this, proven anecdotal examples of success, and then looking some of this data also? What do you say?
Yeah, I mean, it's like anything in research where anytime it's kind of like you take any hot button thing like climate change, to pick anything. Anytime you have people that have strongly held beliefs on the two extremes of something, it's usually the case that the truth is probably somewhere in between, right? And same thing here. Like I could go find you a Nobel Prize winner that says go buy Vanguard funds. I could go find you a Nobel Prize winner that says do like something similar to like Warren Buffett or whatever, right? It's art versus science, but I would say I don't know the answer, right? I have my own personal preferences where I lean more Munger and Charlie, not that extreme, and less Bogle. But I think it depends on what your utility function is, right? Like if you want to put zero effort into anything, and I'm in a position of just protecting wealth, and I'm not trying to build wealth or like add that much value, fine, go buy the Vanguard fund. If I have $1 billion, do I really need to turn into $2 billion? by taking the risk that maybe I screwed up or I'm under diversified? Probably not, right? Like, what's the point? The easiest way to be 100 millionaire is start with 1 billion and have a 90% drawdown, right? Like, great, you still got 100 million, but you lost your ass. So I would say in certain cases, fine, just diversify across as many risks, as many securities as humanly possible, and just keep the costs, keep the taxes down, call it a day. But if you're in a situation where you feel like you have the temperament and behavior to maybe deal with, like, benchmark, deviations or what have you, got like 20-year horizon, and you feel like you have enough confidence in the strategy or system that you're doing, that if you stick with it, you have a decent chance of being better than just being over diversified, then you could lean towards that way. Like, obviously Charlie and Warren, they're on the extreme, or like, Bitcoiners are like, I'm all in on Bitcoin. Like, that seems insane to me. Just because you have no diversification and there's way too much confidence, but maybe something a little bit away from that. Like, okay, maybe I do, like Charlie and Warren say, maybe I got 10, 20 bets. One of them is Bitcoin. One of them is, I don't know, like, this Costco or, whatever the heck it is. And if you kind of go in that framework, obviously you just have to be damn sure and a lot more confident in your work that you're going to be more often right than wrong. You just need to balance those things. So I don't know. It's art versus science, I would say.
That sounds like a very good and reasonable answer. I mean, for most people, they're not going to be Charlie Munger, and even people who are trying to be Charlie Munger are still mostly not going to be Charlie Munger. For a few of the really, really, really capable people, yeah, they should be Charlie Munger. But for most people, do something different. Let me ask you kind of a weird question in terms of ETFs, because we've got all kinds of ETFs, and philosophically, to what extent does consumption belong in capital markets? And I say that because, in much of the rest of the world, investing is gambling, or kind of gambling in their mind. In the US, we have this idea of, like, I own a company, I own a piece of the business. We still trade too frequently, according to a lot of research. But, compared to most other people, we got that idea. But now we've got ETFs on, all kinds of extremes. And I interviewed a guy with a 3X NVIDIA ETF. That's very interesting. And what I was interested in, the long-term holding, you're not supposed to hold long-term, but if you do, if the asset goes up, you can make phenomenal returns.
Yeah.
You could argue, though, that that's also a little bit blurring the line between investing and gambling. It's okay if the individual understands that. Maybe that injects volatility into the market, which is a valuation reducer. Where do you come down on that?
So I'm by nature like a libertarian freedom guy. So hey, if as long as consenting adults want to be degenerate gamblers and they're aware of the risk and rewards that come with that and the cost of the taxes, great. You could go have a party, right? And I got no problem with that. Like, I'm not going to judge. Like, that's just free market, fine. And obviously our marketplace, and clearly there's demand for degenerate gambler ETFs, right? They're going crazy. Personally and culturally, that's just not my jam, right? And that's what, like, our ETF platform in particular, like, we run, I don't even know, 58 or almost 60 ETFs, something like that. I mean, I don't judge individually, but generally all the kind of strategies on our platform are kind of more like, they're like investment strategies, or there's some logic. They're not meant to placate degenerate gambler, like short-term get rich quick type things. They're, I may not like the strategy, or I may not think it's going to be as good as X, Y, or Z, but they're kind of like legitimate professional products. Just because I believe in the long game, those will be around, and I want to help entrepreneurs that are kind of like long game players. Whereas, degenerate gambling comes in waves. Like Ben Graham used to talk about that on Mr. Market, right? Like, when the market's going up every single day, obviously there's a lot of degenerate gamblers, a lot of excess liquidity, a lot of animal spirits. But this train can also go the opposite way, where people start caring about cash flow again. And I just can't time that, but I just know that that's very cyclical. And so we don't particularly participate in that, but I don't personally have a problem with it. But obviously, buyer beware, just like going to a casino.
So let me ask you this then. And you mentioned some of the funds you have through Alpha Architect. If you had someone, Wes, let's say as a young person, man or woman, who's come from a cattle ranch in Colorado, or
Yeah,
maybe come out of the service, maybe someone who's not a career investor, not
yeah,
that into investing, but knows he or she needs to invest to have a good retirement, and they
yep.
come to you for advice, what are some of the most important pieces of advice you'd give them?
So, we tell them focus on the facts. And you know, because good military people like acronyms. Like that's why we created this. So what does the facts stand for? Well, what are the fees? Keep fees, all else equal, keep fees as low as humanly possible, because that's the easiest way to get screwed, right? And this is not like all the time, every time. But if I'm just starting and I just want to protect myself from like the nefarious financial service industries, which let's be honest, it's not exactly aligned with your incentives
Hmm.
broadly. You got to focus on the facts. So fees, find the cheapest thing humanly possible. Access, i.e., liquidity to your money. Find the most liquid, tradable, easily accessible thing possible. C, complexity. Minimize it. You want to buy the simplest, most brain dead thing that your grandma understands what's going on. T, taxes. Uncle Sam will literally destroy you. And if you're day trading, you're giving half of that back to the government every year. If you simply don't day trade, you get a compound tax deferred, and you're going to make a lot more money. And then S, it stands for search. Like that just basically means like your own time that you've invested trying to figure out the best, way to make money. Like what's the cost of your hourly time, right? And so most of the, when you focus on the facts for newbies, it leads to the conclusion, just go buy a Vanguard fund. Just go get some cheap Vanguard fund that buys everything, throw away the key, call it a day. And then that's your base. If you want to layer on sophistication as you feel like you have more confidence to get into the weeds of the facts, that's fine. But I'm not going to go recommend like, hey, go buy a bunch of like deep concentrated value fund that Wes runs, because for most people out the gate, unless they have some level of kind of education or understanding of how financial services work, it's just not going to work out well. You're going to always be in at the wrong time and out at the wrong time. Just go buy Vanguard fund.
All right, so Wes, it sounds like your advice to someone new to investing and not really that into investing is basically to buy a Vanguard fund, keep your fees low, keep things simple. That makes total sense. What about
Yeah.
someone on the other end of the spectrum, someone who's got some assets, maybe high net worth or ultra high net worth investor, maybe someone who is a bit more sophisticated? What are some of the factors? We talk about factors as things that cause stocks to go up and down or investments to go up and
Mm-hmm.
down. What are some of the factors or strategies that you think are particularly well timed right now?
Yeah. So what I always like to tell folks is it's not really the amount of wealth you have that correlates with sophistication. It's the amount of effort you put into education and
Mhm.
understanding, right? So I know people that have $1,000 that are way smarter than the billionaires I deal with, right? And I have some billionaires that are really sophisticated. So in the end, your wealth does not define you as a good investor. In fact, a lot of times you got a lot of money, you're usually the biggest idiot because people like to placate your ego and tell you stupid
Mhm.
shit you shouldn't do. But if you have baseline understanding, you have good common sense, good kind of like spidey sense to get away when the three-piece suit shows up. You're 90% of the way there. And so what factors do? Factors is a way to view the marketplace through characteristics and evidence. With the simple idea is like, hey, some stocks are cheaper than other stocks. Some stocks are smaller than other stocks. Some stocks have higher momentum than other stocks, et cetera, et cetera, et cetera. And then what academics have done is there's a lot of research and theories about, well, cheap stocks. Do they make higher returns? Do they make lower returns? Are they higher risk? Are they lower risk? Whatever, right? So, and then once you take the view that the whole market is basically factor investing, it makes it easy and sets a framework. Because, for example, what is the S&P 500 or the generic market through the lens of factor investing? Well, the S&P 500 is basically a mega cap, expensive, high quality US factor fund. And so one must ask the question, what is the expected returns of a factor fund that holds characteristic stocks that are really expensive, mega cap, high quality, and US based? Well, in general, on average over long periods of times, a factor fund, those factors lead to okay returns, but there's other factors and characteristics that lead to, in general, higher returns, also arguably higher risk. And so there's other returns that might, or other factors that might do that would be like cheap stocks. So, cheap stocks, even if they're dog meat, low quality, doesn't really matter. If you buy cheap stocks, like all the stocks that have less than 10 PE, and you're willing to kind of hold your nose, on average, those securities over long haul have much higher returns than those that are really expensive. Similarly, like small stocks generally are better than bigger stocks. Weirdly low quality stocks are actually not as
Lakana Shock, Schleifer Vishny, 1994, right?
there's all kinds of research on this. But if I have 20-year horizon and I'm standing right here, and let's say there's zero fees on everything, zero taxes and everything, because that's also big. The facts are always a consideration, right? But let's pretend those got magically put away, and you can do any strategy for free with pure tax efficiency, which you can almost do in ETFs now. And I say, okay, option one, I got 20 years, and my goal is to throw away the key for 20 years and try to get the highest compounded return possible. And I'm not a baby. I'm not going to like sell when the market's doing bad. I'm disciplined. I just got 20-year horizon. Option one is I can go buy like I said, the mega cap, expensive, high quality US equity fund called the S&P 500. It'll probably do okay. It'll probably earn some returns. However, if I had an alternative to buy the, dirtball, most cheap stocks that are high quality, or I buy portfolios of what they call momentum stocks, on average, over long haul, those securities are probably going to deliver you higher returns. They might wiggle around a lot more, but if your objective is 20-year horizon, let's try to like compound maximally. The best bet from an evidence-based investment perspective would be to tilt towards things that obviously earn higher returns versus lower returns. So you'd want to probably make your portfolio have some of these factor characteristics versus just buying the market and thinking it's going to like replicate what it's did over the last 10 years.
Gotcha. And so just on brass tack specifics, I'm looking at a chart right now. Maybe we'll add it to the screen later, from Charlie Bolello, showing that from July of this year, U.S. small caps have been on quite a tear, up 12.9%. U.S. large caps just 4.1%. U.S. large caps growth negative 0.4%. So kind of the big sexy stuff that was doing all the rowing for the past few years is now kind of come back down to earth. Do you think, I mean, we've had a few false starts in value now. You could argue it's been not just the past couple of years, the past 13 years, 14 years, whatever, we haven't had a good value market. Do you think one is coming, or is this time forever different?
I don't, that's a perpetual question. And the only honest answer is nobody knows. All I know is base rates and financial economics and like the long game evidence. I always bet on the long game. And me personally, what the heck do I do with my own money? Because I actually have an objective of 20-year compounding, and I don't care what the S&P does. So I'm going to put a lot of my money in really cheap, high-quality stocks. And just because fundamentally that represents what I call the fear trade in the market, right? If you're buying really cheap stocks, guess what? When you look at the names, there's always going to be a reason that they're terrible, they're going to go bankrupt, blah, blah, blah. I like fear trade. I don't know when the fear trade will pay off, but I know markets are driven by fear. I also like the greed trade. People are speculative, monkey, they're maniacs. As you just mentioned, there's all these degenerate triple levered, gambler funds. That to me is captured by what we call the momentum trade, buying the winners. And if you buy winners, they tend to keep on winning. I don't know when fear or greed works in the marketplace, because they tend to oscillate. I just know that in general, humans are going to deliver you excess return if you could be on the opposite side of those trades. So I love buying fear and I love buying greed. And because of diversification, I don't want to be all in on fear. I don't want to be all in on greed because I can't time them. So I just 50-50 them. I love momentum stocks. I love value stocks. I cannot tell you with a straight face when one will work and one won't work. But I just think on average, that's an edge bet versus just buying the market that's overpriced mega cap US equity quality fund. Because we already know those factors suck over the long haul. Why would you do that? I mean, there's a lot of reasons why people do that, but just from a pure evidence based kind of scientific lens on it, that makes no sense if your goal is 20-year compounding.
I love, Wes, that I can't get you to take the bait on any like short-term prediction type of thing, and to be fair, the prediction accuracy is pretty low of short-term predictors. I was writing a piece on this recently. Instead,
Yeah,
you gravitate towards the timeless principles, which is the much better answer. And, I tend to say in the market, you make money by exploiting the cognitive weaknesses of other investors. And it's just social
yeah,
science, right? And so by going into value, by going into momentum, you sort of de facto do that. That is a
yeah,
fantastic answer, if you don't mind my saying. So if someone is watching this, Wes, and says, wow, I agree with that YouTube commenter that the ratio, Wes's ratio of intelligence to pretentiousness is the highest in the business, and they want to learn more about you, Wes Gray, or about Alpha Architect, or about ETF Architect, both your businesses, where would you
yeah.
send them?
Well, just alphaarchitect.com is one place, and then
Easy
we hang
enough.
out on Twitter, which is X now. It's just also easy enough at Alpha Architect. And then obviously, if you're interested in like launch an ETF or infrastructure, which probably people aren't, but who knows? Obviously that's all at etfarchitect.com, and that they don't really have like social media because no one wants to talk about ETF
B2B,
infrastructure.
yeah, yeah.
Yeah, more like a B2B thing. So we probably have some handle, but I don't know. It has like 5 followers. So yeah, alphaarchitect.com or etfarchitect.com.
We'll put both those websites up on the screen in the show notes and a link to your Twitter/X as well, Wes, you've been very generous with your time and with your wisdom. Like I said, we need more people in this world and in this country like Wes Gray. So thank you very much, Wes. And thanks to you guys, as always, for watching us at home.